Thank you once again for joining us. But when you see a market like this, it's worth getting a poly, isn't it?
I'm not a very day-to-day market watcher because that's not the way I work or First World works.
No,
So
we are at an all-time high, almost 2%
yes, I
away.
know. I was listening to you. So
No, we are almost at
it's,
an all-time high, and 1% here, 2% there does not matter for the way you look at things. But the difference in
yeah.
the
Of course,
all-time,
that is the thing. So that's the. I would like to go by the broad things rather than the day-to-day movements can just make you get caught up in things which don't matter. There's a lot of noise in the day-to-day things.
Devna, when we touched an all-time high exactly a year ago, the print and the underlying market conditions were very different. Technology stocks were in a rara bull run. Inflation concerns were not there. Everybody was excited about owning fintech or consumer tech, and banks were on a back seat. But even though the all-time high is nearing, the underlying texture of the market and the underlying bent of the market has changed completely. So what we saw last year was real, or what we're reporting right now will get challenged.
So, Nikunj, the thing is that always in markets, the leadership changes. That is something you have to be prepared for, which is why, there is no point making 5-year forecasts and things like that. And last year we were overweight IT. In fact, we were overweight IT from 2020 onwards, about September, I think 2020 onwards. That served us well. Right now, as you're saying, that it's the banks and financials. And while we are not heavily overweight or anything, because banks anyway are a very large part of the index, but for the first time ever, we are about market weight on banks, which normally I'm averse to buying banks, as I've said earlier, also because it's a leverage sector, it's a high risk sector, it's a sector with a lot of negative surprises, which you can't know sitting outside. So I'm wary of it. We had negligible weight in 2020. We had negligible weight in 2021, which worked very well. So again, you see, banking went through a very long period of underperformance. Also, you must, even in this huge bull run. So in 2020, that was the only sector that was in the negative at the end of the year. In 2021, while it was not in the negative, it went up only half as much as the Nifty. So it has catching up to do. Fundamentally, of course, there are positive things like the credit growth, the most of this current cycle of NPAs is behind them. Then as interest rates go up, normally it is positive for banking margins, at least in the beginning, because the loans get repriced immediately, whereas the deposits get repriced over a period of time. So all those things are fundamental positives. They have had a long run of underperformance. So that is a sector, especially PSU banks, that look like outperforming as of now.
Hi, morning. Wondering whether manufacturing is the way to go, especially because of the China plus one advantage. And where within manufacturing, considering it's such a diverse and large sector here in India, would you be actually placing your bets, if at all?
For about a year, we have been overweight industrial machinery and capital goods, that category. So even now, in our portfolios, in our PMS schemes, that would be the highest overweight. So that is something, that again had some of these things which you talked about, because some of the user industries were getting benefited by PLI or China plus one, and also because of the government capex. That was a sector that started to pick up last year after again 10-12 years of underperformance. That had a really, right from 2009 onwards, it has been a dog sector. So that has been a big outperformer for us. There have been stocks which have gone up even 2 times or 4 times. That still continues to be number one. In terms of other manufacturing, what we have started to like have been some auto four-wheelers and auto component stocks, and selectively textile and chemicals. That I don't like to talk of it as an entire sector, sector because the dynamics of individual companies are quite different. So that is again a sector where because of certain stocks we have picked, we probably be somewhat overweight. So that would be broadly, if you talk of the manufacturing bits, what we like, those would be it.
Devina, hi, morning. So clearly, those are some of the sectors that you're looking at, but just wanted to know what should be investors' approach at a time like this when it comes to the broader markets, mid caps and small caps. Just earlier, when we were interacting with our technical guest, he was saying that as of now, we will see some sort of a catch up when it comes to the broader markets. What's your advice?
Yeah, our systems also, even on a bottom-up basis, are liking more small caps and mid caps than they used to. So, we do a sort of zero base rebalance every quarter. So when we did it in October, we noticed that a lot more of those are coming up, and broadly that does look a bit better than the large caps. Of course, we are very risk oriented, risk management oriented PMS house. So we still will not have a very, very high weightage to small caps, for instance, but we have upped our small cap and mid cap weight from where it was because our systems are liking it more, both as a category as well as number of stocks that are now coming up in our systems.
Good morning, Devina and Nanta also joining in on the conversation. I was wondering, today we're going to see two IPOs close. First, Medanta, the hospital brand, and the second one being Bikaji. It's namkeens, chips, very popular. I was wondering, have you subscribed to any of these IPOs? What your views are, what you plan to do? Today is the last day.
No, I mean, generally we do not subscribe in IPOs. That we have not been doing. So, I mean, we'll wait for our post listing and see and take a view thereafter.
Okay, fair point. You've said that you like to stay away from the small caps as well as the mid caps. You like to have a little less of a risk-averse strategy. Now, having said that, there are a lot of stocks in your portfolio. If I want to see it in the way they're just going up. Reliance Industries, ICICI Bank. I know Nikunj spent a lot of time talking to you about banks in particular. Will this also be a time to hunker down and look at the smaller PSUs? Is that something you would look at?
Yeah, I just mentioned that some of the PSU banks, within banks, we think the PSU banks would outperform. Not necessarily, we may not go to in anything very small banks. And it is not as if that we do not invest in small and mid caps. I just said that we cap that investment at a certain level, particularly in small caps, because in small caps, the risk is that when things go south, suddenly the liquidity disappears. So we don't want to, take those kind of chances. So that's why we will never be 40% small caps or something like that. So that was the point that I was making.
Let's address a very core, basic, fundamental question for our viewers. Now, we may be at an all-time high on the Nifty, but if I look at sectors and the earnings which have come out so far, there seems to be a renewed optimism. There seems to be a renewed vigor, whether it is from the financial space or the manufacturing space or even cyclical space. So for an investor, how would you map the risk-reward ratio? And I'm just bringing this point out for our viewers that folks remember markets for a long-term investor are slave to earnings. So if earnings are good, markets will catch up. And if earnings are bad, markets will come down. So based on risk-reward ratio in the earnings cycle, Devina, what should our viewers do?
While that is true, it is not one-to-one on an immediate basis. That is also something to keep in mind. If that were the case, then in March 2020, the markets in India and for that matter globally would not have rallied the way they did because there was so much uncertainty on the business and therefore on the earnings front. There were whole sectors which had practically no business for months on end. So that is, while you're right that on a longer term basis, there has to be some synchronity, but it doesn't hold on a year or definitely not on a quarter basis. So that is why I always say that the economy and the markets are two different things. So, like for whether globally or in India, there might be issues in the economy, but the markets might still look good, or vice versa. Vice versa as China, which is still not, which is half of its 2007 levels, even though GDP has gone up 6.5 times. So it is so while you must look at all these things, but it is not a one-to-one correlation. So that is something, especially on a market-wide basis, on a stock basis, it's different. So that is something you have to keep in mind. And of course, in India, the listed space has benefited because there has been more formalization of the economy, more move towards the organized sector, which has helped them. So that's been a positive for them. Also, generally, the listed companies tend to cater to the more affluent customer, or at least above the middle, which is the part of the citizenry which has done well. It is the organized sector employees which have done well in the last couple of years. There is still a lot of part hurting below that. It's improved a bit, but you look at Narega numbers or free rations, there's still a lot of people who are in distress. Of course, even in there, you have seen some improvement. So while last year two-wheeler numbers were at a two-year low, now from there it has definitely improved significantly. So you really have to split out what's happening everywhere. So that is that would be my advice. As I said, even sectorally you can't always make calls. Like in chemicals, if you see, the earnings are in two different directions depending on whether output prices have gone up or input prices have gone up for that particular company.
Devina, great to have you on the show. Good to chat with you as always. Let's just revisit what the market then is settling in at. About how